first of all, Brent, thank you for being willing to have the conversation. You have an awesome background working at PIMCO, working at Parametric, which a lot of people might not know, but that's the OG of direct indexing right there. And really the leader in that for several years. And then what you've done with Tax Alpha Insider, I look forward to Sundays whenever I get that across my desk. And you have piqued a nerd like me, my interest, and so hopefully other people find it valuable as well. But yeah, thank you for being willing to have the conversation for sure.
Happy to be here. Like I said, I'm happy to talk tax alpha all day, every day. I think it's one of the most durable sources of alpha for end
Yeah,
investors. And so there's just so much nuance to unpack that I'm happy to evangelize this flavor of investing.
yeah. So yeah, that might be actually a good start. Is can you explain, for the layman, what tax alpha is, right? We hear that term get thrown around so many different times, and what I find is I'll even hear myself using it in meetings, and then forgetting. Most people don't really know what that means. So if you could break it down, like maybe we're 5 years old, right?
So I think about tax alpha. what- Before I get into like the simplified definition, just suffice it to say that there is like a precise technical definition.
Yeah,
But let's set that aside for a minute. And the way that I think about tax alpha is just the value of making tax informed decisions in the portfolio. So if you had imagine a completely tax ignorant or tax agnostic approach, so you're realizing capital gains, you're rebalancing regularly, and tax is just not really a thought versus a strategy where you're employing all the tools of the trade to defer capital gains and to realize losses to accelerate them. If you take the difference between those two approaches, that to me is tax alpha. Now, again, there's a very sophisticated definition that we could get into, but the simplest thing is the difference between tax management and no tax management.
yeah. Why do you think this is not talked about as much?
It's really boring. So I think it is. I mean, I like it. I'm a like a sort of a board gamer strategy type person. Like I grew
Sure.
up playing like Magic the Gathering. I also played a ton of poker and blackjack. And to me, the tax code and the way that tax management manifests in the portfolios is very much a game. And I don't say that lightly. I say that like in a dead serious, like I'm going to win this game kind of
Yeah.
way. And, but most people don't see it that way. I think most people are very attracted to headline stock movement and outperformance, alpha generation, and the billionaires behind those strategies charging insane fees.
Yeah.
Tax management is a totally different world. Sometimes they overlap. Increasingly, they're overlapping. It's very interesting. But in general, we're talking about boring, not to me, but boring to most people versus headline sexy. And
Wow.
that's the messaging that I have to overcome. Like, no, actually, tax management is very cool. You just have to be in a very strategic, different kind of mindset.
Right. Yeah, it's funny too. Most people, why would you know this? But alpha, if you look at like CFA or finance textbooks, alpha is a residual term. It's an air term, right? And so this is something that we can't explain that this person was able to do, and we're going to say this is either skill or luck, and we're going to hope it's skill, right? And that's what alpha is with a stock picker. The difference in why I'm so drawn to it, and I think you as well, is you cannot use the word guarantee in what I do day in, day out, right? But if you do your rebalance in an IRA versus your taxable account, and you're selling some stocks, and over here, you had a capital gain, and over here, you're deferring a capital gain, I can guarantee you're paying less taxes this year, right? All else equal, big asterisk. So yes, I'm saying the word guarantee, but that is alpha that can be attributable to decisions that are within our control, which I think is so incredibly powerful.
Yeah, I think you're right. It comes down to skill versus luck in a lot of cases. I think that's a great point. In tax management, like it's very programmatic. So set aside pre-tax alpha for now, but tax management itself and post-tax alpha are in some ways deterministic Like we know what the outcome is going to be based on volatility in the markets, things like that. In other words, it's a durable source of alpha. And in some ways, it's very measurable. In other words, we can attribute tax alpha back to the individuals who actually proposed and executed those actions. There's almost no skill versus luck debate in tax management. It
Yeah.
is skill, it's optimization, um, it's efficiency manifest
Mhm.
in the portfolios.
Yeah. So, what would you say are the biggest levers that an investor, and when I say investor, I'm talking about a retail investor, right? Because obviously, if you're managing a pension, you don't care about any of this, right? But the retail investor who has tax deferred, tax free, and taxable money, what are the biggest levers that they can pull to generate tax alpha within their portfolio?
Well, and Andrew, you'll appreciate this. I mean, probably the highest level, we're talking about asset location
Yeah.
before we even start talking about tax trading and timing and harvesting, any of that business. So, okay, let's just make sure that we have like the right assets in the right accounts. And I'll leave it to you to kind of get into the weeds there, but that's probably where I start. You've got pools of capital in different types of accounts with different tax treatment. Make sure that you get the right assets in the right accounts. Start with that.
Yeah.
Once you've maxed out the tax exempt and the tax advantaged buckets, okay, now what can we do in the taxable account? And it depends on the circumstances, but the idea is almost always that you want to accelerate losses and you want to defer gains. And that difference right there that is like tax strategy in a nutshell.
Yeah.
But there's more stuff we can do a level further. And again, you know this stuff well, but whenever we have to sell, and it might be for consumption because we're post retirement, or it might be because we're managing risk in the portfolios. We're trying to, hug close to a model or a benchmark. Whenever we do that, we want to do so in a tax thoughtful way. In other words, let's prioritize selling long-term capital gains with high cost basis before long-term capital gains with low cost basis, before, et cetera, short-term capital gains, high cost basis, low cost basis. So we want to be like really thoughtful about the order that we execute whenever we have to execute. But another thing here is that we're always considering the trade-off between tax and risk,
Mhm.
and like balancing those two, I think is another part of the game. And that's where this stuff gets really complicated really quick. This is where you got to get computers involved because, there's just a lot of gnarly bits to keep in mind.
Yeah, and it's one of those things too, and this is somewhat anecdotal, but where I remember when I was doing a lot of high level trading, and sometimes you press a button, and what the algorithm spits out, because for people who don't know, what you do is the assets within the model, you give them a tax preference. And so really tax inefficient assets, you'll give it a score, usually 0 to 100 of, depending on the program you use, 100 is really inefficient. And so, yeah, a taxable bond or a high yield bond, I want that to always go in my IRA, all else equal. And a municipal bond, I always want it to be in my taxable account, right? Because it's tax free. But sometimes, even when you have those preferences set correctly, you'll press a button and you go, why in the world would I want my Roth IRA, which is, $500,000, to be all emerging markets? The algorithm's doing the correct thing by saying, hey, this is the highest anticipated return, but you also have to bring it back to reality of saying, these are finite resources over here. I can only increase my Roth IRA and my IRA at such a rate. And so therefore, I may do something that's slightly suboptimal to keep some diversification given my present circumstances, if that makes sense.
Yeah, 100%. I mean, they're like, I think it'd be interesting to get your take on this, but if we zoom all the way out and we think about risk and tax at the household level, so all portfolios in tandem, I think asset location is one of the most readily available manifestations of that, right? Put the bonds in the tax advantaged account so that you don't pay tax on the income distributions from those bonds, or ordinary income, in other words,
Yeah.
uh, income distributions if it's from an ETF or a mutual fund. But essentially like you want to keep that party going as long as you can, like without paying taxes. So you have no drag in those accounts. But in general, like we have a household risk allocation. And so we're talking about, I don't know, let's say anywhere from 3 to 10 portfolios that you're trying to balance across
Yeah.
potentially multiple spouses. And if we zoom all the way out, are we talking about, I don't know, 80/20 equity fixed income or fixed income equivalent? Doesn't have to be fixed income nowadays. There are more tax efficient ways to do fixed income. But back out 80/20, equity fixed income across the entire household. Okay, where do we put the assets?
Yeah.
Do we have to keep equality between the spouses? I call this the divorce case, but one spouse doesn't want to hold all the municipal bonds, the other one's holding all the growth equity, and then things go away, and maybe they're unhappy with the existing composition of the portfolio. So do we have an additional constraint there? And how do we balance across all the portfolios in a tax optimal way? That's called householding. Householding is, I think it's a frontier area that I'm super interested in. It's one of my 4 big growth areas in tax management this year.
Mhm.
But like getting that right, super complex, very interesting. But that's where folks like you at the wealth management layer are very interesting. That's value add to coordinate across all the different tax advantaged vehicles across multiple folks in a household, potentially across generations.
Yeah. Yeah. And this is a leading question. So my apologies at the outset here, but why do more wealth managers or financial planners not view portfolios at the household level?
That's because it's complex. I mean, I think that a lot of them do, um, a lot of them try or are at least aware of household level portfolio management, but it's very complex. I mean, you're dealing with multiple constraints. Oftentimes the objective is to be determined. It could be a suitable amount of cash, it could be wealth transfer. It just depends on what the objective is. But I also think so first it's complex. The next thing is that I think that the tooling for household level risk and tax management is sort of fundamental. It's still in development.
Mhm.
And I do think it's a powerful area where wealth managers can add material value because what they're doing at your layers, you're taking the risk preferences and also the priorities from the household. You're turning that into investment management. And I think like that mapping of human into money and investment is very valuable. I just don't think it happens as much yet. It's going there. We're heading in that direction.
I would agree. And, at its most fundamental level, and I'm not trying to pick on my fellow, wealth managers here, the existence of municipal bonds in a taxable account versus your taxable bonds, or excuse me, yeah, your taxable bonds in an IRA, uh, that is asset location, right? It's just the first layer. And what you and I are talking about here is getting from 95 to 100% efficiency is incredibly complex. Getting from 0 to probably 75% efficient within householding simply by weighting your Roth IRA towards equities, your IRA towards bonds, and your taxable account towards municipals, depending on your tax rate, you've achieved some tax efficiency there just by doing that, right? On the wristband. But getting from that that last 10%, incredibly complex. And I think you hit on something uh, really important that I'd be curious your perspective on. At the sub-advisor level, I guess 2 questions. Are you starting to see a difference at the sub-advisor level of some sub-advisors stepping up to the plate and really trying to take this on? And number 2, if that's not the case, why not with that?
Yeah, it's certainly easier to sell a targeted product. Like I have a thing. I have like a direct indexing portfolio. Maybe I'm a manager who just does direct indexing, and it's very easy to express expertise and specificity with just a single strategy. You have a problem, I have the exact solution. But if you say, well, your problem is householding, so household risk and tax management. it's a much bigger sell, I think, from the sub-advisor to someone like you. And
Yeah.
it's not because it's a bad solution. It's because for that comprehensive management, you're really going to have to take over almost the whole book.
Mm.
And it's harder, I would say, in my mind, practically speaking, it's much harder to fire a sub-advisor who's doing holistic household level portfolio management. You're very much in bed with them. It's much
Mm.
harder to fire them than it is to fire a separately managed account provider who underperforms or whatever, doesn't give you enough attention on the portfolios or is not as nimble during a drawdown or whatever the reason is. It's much easier to fire a very tiny portion of the portfolio
Yeah.
versus firing somebody that you are just like spending a ton of time with because you've given them your entire book. So I think that there's multiple levers here why these things why householding is sort of like not manifesting in the portfolios fully yet. Misaligned incentives to a certain extent.
Sure.
Yeah.
Yeah. So if asset location is possibly the lowest hanging fruit, and let's presuppose for a minute, a big presupposition, but that we've handled that. What are the next layers of tax alpha that we would want to shoot for in a portfolio?
Yeah. So if we want to, yeah, if we're trying to like really dial this in, we're really talking about granularity. And that's when things get a little bit more interesting. So suppose that I have the stocks and bonds in the right accounts. So don't worry about alts for a little bit. You just set that aside, but let's just talk about stocks and bonds as a mode of explanation. Well, if we have individual stocks in the equity portfolios and we have individual bonds in the fixed income portfolios, and some interesting things start to happen. So one, we get dispersion of outcomes
Yeah.
in the equity sleeve. And what that means is that we're going to have some winners in the portfolio. We're going to have some losers in the portfolio. The losers we can sell. We can capture a tax asset that can be used to offset tax liabilities, either presently or in future years. They carry forward indefinitely. So that's the basics of tax loss harvesting. But let's zoom out. Let's start to go across account types right now. You can do what's called location rebalancing. What
Mm.
that means is like, suppose that I have a risk target at the household level. Can I satisfy or rebalance toward that risk target just using tax advantaged or tax exempt accounts? I don't realize any capital gains there, but I hit my risk targets.
Yeah.
Now that's pretty interesting. I mean, that's location rebalancing again. That's like kind of that's a very niche topic. I haven't seen really anyone. I can think of only a couple vendors who are really leaning into location rebalancing as a strategy. But generally, and then again, this will zoom out to your layer because I'm typically a layer deeper than you, Andrew. So if we zoom out to your layer, if you're talking with folks who have moved past the accumulation phase of life into consumption, now we're talking about another set of strategies, which is like, how do we get assets from investments, with minimal tax implications? So
Yeah.
withdrawal strategies, how do these things coordinate between income and capital gains? Uh, It just depends. There are just a bunch of different levers that you can pull depending on where the investor is, where the assets are, their tolerance for complexity, and their tolerance sometimes for turnover, because the portfolios can get really hairy. It's a great computer problem. It's less of a
Yeah.
human problem.
Yeah. Yeah, I feel like within the advisor community, there is this infighting going on, do you just hold the S&P 500 ETF or do you do the direct indexing, right? And Brent, like you mentioned, right, direct indexing is you are holding a representative basket of stocks of whatever your index is, and if you have 300 options for loss harvesting versus one, uh, your opportunities for harvesting losses will be much greater. And there's of course trade-offs like with anything. You tend to have more tracking error with it. But in my research, and I don't want to say this too loud, you correct me where I'm wrong. I've seen with some direct indexing strategies, it ends up being about double the tax alpha of normal index level tax loss harvesting for the first several years.
Yeah, that sounds about right. And back to tracking error. So we're talking about the difference in portfolio outcome in the direct indexing or the separately managed account strategy versus its stated benchmark. Now, I don't want to say that that's actually all bad. I mean, some folks have really high tolerance for tracking error, and also that tracking error is a way to manifest an active um, sort of perspective on the portfolios.
Sure.
So in other words, like you get compensated for that tracking error, hopefully with risk premium. And so it's not, some folks are really sensitive to tracking error. They want it to be zero. They want Vanguard, index-ish like returns, very tight tracking. Other folks are just like, nope, give me as much tracking error as possible because I believe that I'm going to be compensated for taking that risk. And so it's sort of different approaches to tax management. And it really comes down to, again, at your layer, suitability. Like, what does the client want? Does this product or approach really, like, do these things solve a problem for the end investor? And that's where it really takes like really hard listening to the actual problems that you're solving.
Mhm. So if we were to put uh, numbers to kind of the philosophical truths we're talking about here, what I've always thought in my head, and again, correct me if I'm wrong, asset location, depending on the research you look at, uh, is anywhere from 0 to 50 basis points of added tax alpha. When you think of tax alpha, it's if I make a gross 10, but after everything on my 1040, my tax return is taken into account, and I actually bring the tax drag into account, I make 8. What tax alpha does is makes that 8, maybe 8.2, 8.3%, right? And so it's a little more nuanced to get to how these percentages actually work. And I hesitate to say it is 25 basis points of return or something like that. But just maybe to give a framework, I've seen anywhere from that 25 to 30 basis point as a reasonable expectation over a long period of time for asset location. And then on the tax loss harvesting side, that completely depends on what the market does. But your losses are obviously more at the beginning. And it seems like that could do anywhere from 50 to 100 basis points of tax reduction. Is that in line with what you have seen, Brent, or are you seeing some different numbers in the research?
Yeah, man, it's all over the map. But yeah, like ballpark, yes. Like those numbers are consistent with what I've read. And also just seeing and experience, in different places.
Yeah.
But I would say if we're looking at like a totally naive implementation that has like done no tax management, holding tons of high yield bonds in a taxable account,
Yeah.
maybe, I don't know, whatever, some other just like poor asset location implementation, then the win there is actually, I would think, substantially larger,
Sure.
versus something that's optimized and really very thoughtful and considerate. And then on the tax loss harvesting side, we're really talking about different volatility regimes,
Yeah.
how much cash you're injecting in the portfolios. Do you have gains and losses outside of the portfolio that you can use to further enhance return? Are we doing anything fancy like, long short implementations that have just a totally different loss harvesting and pre-tax rationale? Are you doing anything with income strategies, whether derivative based or, real estate, master limited partnerships, anything in there that has additional, let's say, paper losses that can defray the immediate taxation of the income that's coming from those strategies. So, tax alpha comes in all different shapes and sizes. And I would say that, 100 basis points, transparently, I feel like I don't want to put a higher number on it, but I want to say it almost doesn't do it justice because there's just so much happening.
Yeah, and obviously this is being recorded and it's going to be on YouTube, so we have to put a really big asterisk that says your personal situation is not going to be exactly the numbers that we're talking about here. But the important takeaway is that it's non-zero. If you do this, it's non-zero, and it's non-zero every time, right? Whereas if you're trying to be a superior asset allocator or security selector, it's not a non-zero. sometimes it is, well, sometimes it is non-zero, it's negative, right? And it's a really tough game to play. You hit on one that I frankly, I'm not sure I'm smart enough to understand yet, but one area I'm really interested in are the 351 seed conversions within exchange traded funds. This to me seems like an area over the next 5 to 10 years that should find a lot of growth. Would you mind explaining what it is and how it could be useful to somebody?
Yeah, for sure. And Andrew, can I pump my book? I just got it back from the
Do
printer.
it.
Yeah, okay. So I wrote this like silly little book. It's like a good 70 pages. It's real. This is the first time I've showed it in public, but this is like how this works behind the scenes. I'm not selling anything. I don't have any stake in the allocation. I just sell information. And so the book is here. It can give you all the nitty gritty, but in a nutshell, the 351 allows investors to take assets. You have to check a bunch of boxes to take assets, contribute them in kind to an ETF. And so let's say that you've got, I don't know, a really gnarly portfolio at Wealthfront or something like that. And you're just like, well, this is really hard to manage. I'd really like to get it to my wealth manager in a tax efficient way. I'll contribute the assets to an ETF and grant them access, on their custodial platform or whatever. That's one use case. There are other use cases too, but the idea is that you want to get the assets into the ETF wrapper because the ETF wrapper is very operationally and tax efficient.
Yeah.
And Section 351 gives you a mechanism for doing that.
Yeah. And it seems to me the use case, uh, a great use case, not the only one, is concentrated portfolios, and specifically concentrated portfolios of multiple stocks. Because I know there are some limits on, it can't only be one stock, but it reminds me of the, I say the old, I mean, people still use them, exchange funds that people would use where, hey, I have $2 million of Apple. I want to get rid of it, but I don't want to have, a $500,000 uh, tax bill if my basis is zero. And so how do I get rid of this Apple concentration? My wealth manager says this is really bad. And what you, one of the strategies people could use is putting money into these exchange funds, but they have to hold 20% in non-liquid assets. I believe it was real estate. And many times up front, you don't know what assets you're going to get back. But in regards to, hey, using an exchange fund, selling the asset, or seeding through a 351, are there use cases that are better for each of them? Or it seems to me like as 351, so long as you like the ETF it's going into and it meets your needs, would be superior 9 times out of 10. Am I off base here?
They're just different solutions. I'm trying to think if I can pull up a page, or I have a whole page just dedicated to that exact problem. And the important thing here is I feel like a nerd showing my book like that, but the important thing here is that in an exchange fund, you're going from a concentrated position, oftentimes just one stock, into a partnership of other folks who have also contributed generally one stock. But with a 351, you have to contribute a diversified, tax diversified portfolio, and oftentimes, ballpark rule of thumb, about 20 positions. There's two important diversification tests to pass. No single position could be greater than 25% of the portfolio, and then the top five positions cannot be greater than 50% of the portfolio. So we're really talking about different tools, potentially for the same problem, but you're not going to be able to diversify a single stock using 351. Um, the partnership structure is just, it's much more flexible, but these are just trade-offs. Section 351 is for seeding new companies, investment companies like ETFs are an instance of new companies. And 721, which governs exchange funds, is about partnerships. So these are just like different parts of the code that mirror each other very closely. Um, I'll say on the exchange fund thing, there's, a lot of people don't know this, but oftentimes what happens in an exchange fund is investors contribute individual positions. And like, let's say that allows the portfolio to replicate loosely some index. So that's where you get your diversification, like through the partnership contribution. Then oftentimes, not always, but oftentimes what happens is that the portfolio managers for the exchange fund will use the individual assets as collateral. And then they will take the collateral, margin up, and then they will go buy illiquid assets. And they come in a bunch of different shapes and sizes, typically real estate, but it can also be like oil, physical gold, anything like that that has an illiquid characteristic. And there's a really gnarly reason for it. I won't get into it, but it has to do with like preventing diversification. And so they're kind of it's very interesting. The exchange fund world is very old, interesting, and very durable. It's still around. People are still innovating in that
Yeah.
space. So that's exchange funds. But separately in the ETF wrapper, the 351, also old. In fact, Section 351 was introduced to combat the exchange fund.
Interesting.
Yeah.
Why is it just now seeming to catch on? Is it just now kind of getting more to the forefront?
Yeah, it's old. People have been doing it for a long time. Yeah, I can say that with full confidence. And I think certainly I've been writing about it a lot, at least over the past 6 months. I think I've probably written 20 blog posts on it, and I'm pretty loud on social media. And, I think Meb Faber came to the market. Meb has good social presence. And I think that certainly caught my attention. And I was like, oh, I guess I should write more about 351. And then I started thinking about it really hard. And I was like, oh, this could be a different way to invest. It would change how folks think about reallocating and rebalancing. And it's a tremendous lever from an operational standpoint, very, very investor friendly. It's a tremendous change that it's gotten so much attention lately.
You hit on a really interesting point that I hadn't thought about is being able to use it for rebalancing.
I mean, I think I call this the routine rebalancing ideal. And that's where you have enough ETFs coming to market such that, let's say someone is glide pathing their way toward retirement. So they're de-risking. Well, you could imagine a world where you've got full beta exposure
Yeah.
and then contributing those assets. It would have to be an ETF, not a mutual fund, but contributing those assets into a new ETF that has half the beta. Okay, so we're de-risking and there's no tax consequence to de-risking. And so that's actually really interesting. So are we going to see vehicles that are coming to market regularly because you can only seed an ETF in kind at launch?
Yeah.
And so are we going to see vehicles coming to market regularly such that investors have the option to reallocate and rebalance tax free? It's already happening. So if we look at the composition of portfolios after the 351 seed, we see that like oftentimes greater than 50% of the portfolio is other ETFs. It's not individual securities.
Interesting.
Yeah, it's a tremendously interesting development. But yeah, it's been happening for a long time. I think Section 351 was introduced in the 50s. It gets revised occasionally, new guidance, things like that. But in general, it's been happening for a long time. I think council that works on this with some pals of mine who do this, I think he's done over 150 of them in the past, like let's say decade to keep it safe. I think it's much less time than that, but yeah, certainly hundreds of instances of this, I think is accurate.
Well, eh, my mind is going to reason number 2000 to own ETFs instead of mutual funds.
Mutual
There
funds, yeah.
there are use cases for mutual funds, but they are more and more niche at this point, in my opinion. Actually, I think it might be good. Could you just give a quick overview of uh, the mutual fund chassis versus the ETF chassis and why they're different, how they're different operationally?
Yeah, I mean, so in the like the quickest, like simplest, it's not simple, but probably the biggest thing is that the ETF wrapper has an additional layer between it and retail investors or even institutional investors. Between the investing class sits another layer, and this layer is called an authorized participant. And essentially, the authorized participant is a trading partner of the ETF. And what the authorized participant does is every transaction with the ETF is in kind. And all of those in kind transactions are not taxable. And so what that means is the ETF has the ability to transfer low cost basis securities out of the portfolio to its authorized participants. These are folks like Jane Street, Goldman, right? Big brokerage shops who are arbitraging the difference between NAV, the ETF NAV, and the underlying securities value. So they're constantly trading and they're constantly facilitating in kind redemption to keep portfolio value and NAV tight. That's a very like a statement of pride for allocators who are doing a good job keeping the spread between those two close. But the important thing here is that all those transactions are tax free. And what that means is that the ETFs, generally equity ETFs, this doesn't happen in fixed income too much, but what it means is that the equity ETFs generally do not distribute capital gains. So they're rebalancing with impunity.
Yeah.
And that's what's unique about the ETF wrapper. Oh boy, there's an asterisk here, which is that mutual funds actually can kind of do this too. They just don't. What we're seeing in response is a bunch of different backflips to get from the mutual fund wrapper to the ETF wrapper. One way is just a wholesale conversion, mutual fund to ETF. And by the way, that's via Section 351. And it just has not been accessible to like the general investing class yet, but it has been happening institutionally for a while. And then there are some other tricks too. A mutual fund can introduce an ETF share class. Vanguard is famous, infamous for this.
Yeah.
And there's actually another trick too, but suffice it to say, there are ways to make mutual funds more efficient. But the most efficient way is to just not have it in the first place.
Yeah, I think that's the key of what you said, of they can sell with impunity, right?
Yeah,
And
they can rebalance with impunity
yeah,
without tax consequence. Very, very investor friendly. Now, the what happens is that since there's no drag on the portfolio, the investor will eventually pay the tax when they liquidate their shares. So it's a deferral strategy. It's not tax avoidance ever. So, although some might argue that in the interim it's avoidance, but in general it's a deferral strategy. But that's just one of the superpowers of the ETF wrapper.
yeah. Unless you do a 351 seating, right? After your deferral on the tax. Do you see any trends within the tax efficient space that you think are going to map what we're doing over the next, I'm going to say 5 to 10 years?
Yeah, I think a lot of folks, myself included, are very curious about the role of bonds in the typical
Mhm.
portfolio allocation. And so just to like kind of tease this idea, I mean, I have very sophisticated friends who would suggest that commodities are actually a suitable replacement for bonds. Now, that's going to make some people like, flip the table. They're going to like knock over the pitcher of water. They're just like, what are you talking about? We have to have bonds. That's a mainstay of portfolio allocation. But it just turns out that bonds just are just very tax inefficient. And yes, you can do asset location, put them in the right place, but oftentimes that's just insufficient. You still have more reason to reduce the risk of the portfolio, and that commodities might actually be a sensible way to do that, a very tax efficient way to do it. So you want to do it with spot commodity, not with futures. Futures are tax inefficient for complex reasons. That's one instance, but we're rethinking bonds in the portfolio. I mean, another solution is using options and recreating the risk-free rate using what's called a box spread or like using another kind of spread. This is a very popular trick now where we're not distributing ordinary income anymore. In fact, we're distributing capital gains. Moreover, long-term capital gains and usually only at liquidation. So imagine an IRA like treatment or a fixed income like product. In other words, indefinite deferral of kind of an interest rate linked product. And so, do we need bonds anymore? That's a big deal in tax management. So, anyway, option strategies, commodities as a replacement. Do we need this stuff? Options, especially exchange traded, very liquid, less transaction costs, easier to source in a crisis. Also, perfectly negatively correlated if we want, like legitimate protection that is
Right.
not correlation time varying. So kind of interesting stuff happening in, rethinking asset allocation and the way that we should build portfolios toward a more tax efficient outcome. That's one straight. I would say certainly householding we talked about earlier. I think that's another huge development area. Another one is like the tax aware long short stuff. Those are
Yeah.
strategies highly sophisticated, very interesting. They inject leverage and shorting into tax aware separately managed accounts to generate additional tax alpha, pre-tax alpha, and also post-tax alpha. And then probably the last category is solutions for managing or de-risking single stock or concentrated positions. I see a lot of innovation there. Um, whether it's bringing complex strategies down to smaller portfolio sizes, a million plus things, typically 50 million plus, and now we're getting down to a million or 2 million plus, things like combining a variable prepaid forward with a completion portfolio or a tax aware long short implementation, more strategies inside of exchange funds, complex collars, using using OTC options instead of exchange traded. I mean, Andrew, I know I'm going way over the deep end here, but those are the four buckets of innovation and tax management in my
Yeah.
mind. Like, again, householding, rethinking bonds, tax aware long short, and then innovation and single stock de-risking.
So with the rethinking bonds, first of all, thank you for that context. And my mind is swimming a little bit right now with questions. On the rethinking bonds through the spread, are you is this in it through an ETF, or is this you're just going out and buying the options like through leaps or something like that?
Yeah, it's usually in the ETF wrapper. And the reason is that you can redeem in kind exchange traded options. Most people don't know that. They think that if you're going to redeem in kind, it's like what we discussed earlier with the authorized participants. You redeem in kind normal equities. That makes sense. Vanguard's been doing it for decades. Most people don't know that you can in kind exchange traded options. And to take it one step further, you can redeem in kind combinations of exchange traded options.
So that's how they're able to roll them, right? Without that tax
Exactly.
event occurring. Okay, because that was going to be my next question is, well, the average option contract, let's say it's 3 or 6 months, right? When's my liquidation going to happen? Am I going to have to do a new ETF every 6 months or something like that? But you can use the authorized participant structure through the ETF chassis to have an ETF that does the same thing in perpetuity until you decide to sell it.
Yep. Yeah. You can imagine so yeah, if the options contracts are something like, like you said, they're pretty short term, short tenor. So 4 weeks to 6 months, something like that. So as those things approach maturity, the ETF will reach out to its authorized participants and say, we need to roll that might be the word that they use. It's certainly the word we used at PIMCO when we were rolling a strategy that had an expiring tenor. But I don't know if that's the exact word that they use, but conceptually, it's the same. The idea is that we need to restart this position and we do not want to realize capital gains as we're restarting this thing. So what they'll do wholesale is they'll redeem in kind the entire strategy, not individual legs of the strategy, the entire strategy. So if it's a box spread, they'll do all four legs of the box spread in
Wow.
a single go. And the authorized participants are like, great, we use box spreads every single day for managing capital. Great. We're happy to take all four legs in the same go. And what that does in effect is allow the ETF portfolio manager to essentially reinvigorate the option positions to extend tenor without realizing capital gains. And also, you don't realize you're just deferring the entire time. So anyway, that's one of the options ways to do this, but the important thing to keep in mind is the ETF wrapper is very special in the investment landscape.
Yeah. I mean, the way I would maybe want a retail investor to think about it is assume for a second that you have a US Treasury bond and it's yielding 4%. Right now, you have a coupon with that. That's usually paid semi-annually. And sometimes the coupon's 4%, sometimes it's not. But for sake of the argument, it's 4%. Uh, Twice per year, you're getting $20, right? With this, you're getting the equivalent of $20, but you're not paying the $20 on your taxes. That's the difference. You can wait and that $40 compounds and compounds and compounds until you decide I'm selling the ETF. And whenever I do that, that's when it hits as a long-term capital gain rather than its interest income as it occurs. Is that a correct representation?
Yeah, exactly. Yeah, there's like three like concrete benefits. The first one is that the character of the distributions is capital instead of ordinary. So that's a big deal for other reasons, but just that's one of them.
Yeah.
The second one is that hopefully you're getting long-term capital gains treatment instead of short-term or the short-term rate. That's also very good for a fixed income product. That's just like not really a thing. And the last one is deferral, just like you said. So this thing just keeps on compounding in the background and you don't have to even think about it. And so, like I said, it's almost like if you had all your treasuries in, a tax advantaged vehicle
Yeah.
and the compounding just kept on compounding. The important difference, of course, is that you're going to realize long-term capital gains when you sell the ETF, whereas treasuries in an IRA, eventually you're going to pay ordinary income to get the assets out of the IRA. So yeah, I mean, we need to think about like how the ETF wrapper transforms, just to zoom all the way out, household asset, location, and allocation. The wrapper changes where we put the assets and how we think about deferral, gains realization, withdrawal strategies, risk mitigation, reallocation, all this fun stuff. I mean, it changes it. It's that powerful of a, you use the word chassis. I actually really like that versus wrapper. But that chassis um, changes how we think about location and allocation.
Yeah. Not to mention the fact if you put it in the capital gains world, then if you're doing systematic loss harvesting, that now applies. Whereas before it was only a $3,000 offset to your ordinary income. Right.
Exactly. And so it's very hard to find ordinary losses. Like there are
Yeah.
ways to decrease ordinary W 2 income, but in general, the best way to decrease ordinary income is to not have it in your investment portfolio. So if you
Yeah.
can keep everything capital, then you can start, matching gains and losses very thoughtfully.
Yeah. Wow. That's a lot there. Well, Brent, thank you so much for being willing to talk through all this. We covered a ton, right? And I think maybe the bow on this is thoughtfully locating your assets and within that framework, adding these layers of efficiency on top of it, right? They are not mutually exclusive. They're additive. And because of that, we can really try to reduce as much tax drag and capture as much of that tax alpha, right? Recapture that return that you're losing to taxes. And the beauty of that and why I'm so passionate about it and why I know you're even more passionate about it than I am is you can do that with high probability. Whereas trying to outperform the market, I don't care who you are, it's incredibly difficult. But if you can be thoughtful like, in so many of these different strategies that we talked about, every dollar counts at the end of the day.
Yeah, people live in post-tax world.
Yeah.
And so if we can help them keep compounding such that when they actually need to withdraw from the portfolios for consumption for the next generation, whatever it is, we help them maximize wealth before they have to withdraw and then also keep it when they have to withdraw. And that is tax management. And yeah, it's a lot of fun. It's very interesting and valuable for end investors. That's why it gets me so worked up every day.
Yeah. Well, again, Brent, thank you for your time. I appreciate you being willing to have a chat on this.
Yeah, for sure. Anytime we'll do it again.
All right.